Hello and welcome to the Harwood Report for October 29th, 2018. I am Keith Harwood, the founder of Trade Academy. Let's do disclosures. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Take a moment to read through the rest of these disclosures. The key here is that I'm not giving you any sort of trade recommendations. All right, folks. That should do it. We're going to talk about these equities because they are crazy. We've been trying to balance out how big each of these macro inputs are on the market. And I think a lot of that has driven to a general risk off feel for the market. So between Italy, which, got some news updates and things are maybe getting a little bit better there if we look at the BTB Bund spread. We look at China, maybe things are getting a little bit better there as they're going to reduce taxes on cars. We look at Brexit, maybe a no deal happens there. Maybe that's an issue. We look at earnings, generally have had some up and some down. So people were worried about Amazon not being good enough, but like Intel was good and Microsoft were good. So where are we balancing here? We're trying to balance out the good and the bad on those. There's a number of other inputs that are going to keep coming in, Saudi Arabia and everything else. That's going to impact the oil markets. And that creates this trading environment that we've got. So where are we at in the trading environment? Well, frankly, we are at extreme lows here in terms of this fear and greed metric, where the VIX is, fairly high here. I mean, it didn't do a February move because there wasn't this massive short positioning and downside options in the market. Basically, I think everybody kind of had a hedge on, so we didn't get an explosion in the VIX. But the market itself, we're seeing a lot of odd behavior here. I mean, look at how many stocks are making new 52-week lows. To me, this actually, I think I mentioned this last week, it's a little bit analogous to the inverse of what happened in January where every stock was going up. Now we're seeing a lot of weakness, and it might just be a bit overdone. I mean, all of this stuff is showing some major negativity that you would expect to see if the fundamentals were bad. Earnings have been good enough in most of these companies that I don't know that this is deserved. And as we come out of this earnings season, we may see a lot of potential for short squeezes from these companies that are trading near lows and start reporting earnings if they start reporting a little bit better than expected instead of the worse than expected, which seems to be what the market is trying to price in here. Okay? You just see all these metrics, a lot of it showing some serious fear here. Let's go to the actual charts and talk about what we're seeing there. Obviously, some fear. We're below every moving average. The 10-day moving average is the lowest now. So we're starting to roll everything over so that the moving averages are kind of stacked negatively. That's not a good sign for the overall market. So for us to see this recover, what do we have to do? Well, first things first. We got to get above the 10-day moving average. That right now is around 273. It's dropping at about $1 a day, looks like. On Friday, the 10-day moving average was 273.72. Today, it's 273, so about 70 cents a day. It means that if we consolidate, the 10-day moving average catches up to where we're at right now in, within about a week or so. If we start to bounce a little more aggressively, then we're going to be flirting with it on, potentially a 270, 272 board within a couple days. So let's also remember that 272... that's where we were trading on Friday. We're getting these big ranges, so it's very easy for us to get back to that kind of level. What does that mean for this market right now? Because that's what you want to know. You want to know how we can look at it as a trading approach. I think we look at this as a trading market, not an investing market. When you've got stock returns like this, it's a lot of work to try to buy the low and sell the high on days like that. And you don't get a lot of money. If you buy low and sell high on days like this, you actually get paid pretty well. So that's what people, I think, are focused on doing. That's what creates some of these big candles, but without a change in the trend yet. If we start seeing a higher high and a higher low, that may be the change in trend. We get a close above the 10-day moving average, that's crucial. Get it back above the 200-day moving average, and it's even more important because then everybody starts looking at the long-term bull being back in the market. What drives that? Earnings, maybe it's Apple earnings this week. Maybe that's good enough to show us that everything's good. Or a conversation comes out between Trump and Xi of China and things start looking better there. I think what we need is a fundamental input that starts getting people excited about U.S. growth again. And right now, the most obvious ones to me would be something progressing with China and Apple earnings. In the meanwhile, I kind of said last week that, if we broke here, the 265 might be a natural stopping point, and it seems like that's kind of holding for now. If we start to firm, I think we're looking for a move back towards 280, maybe a little higher towards 282. That would be kind of the upper end of the range. If we can get below here, the move wants to maybe go all the way down to the February low at 253. But I think that there's going to be some support in here from what sort of chop we had. So I don't think we're looking necessarily at a fast break. And if that's not the case, then the options market's not great priced really well for me to make that kind of move. Options are expensive. I could do something with like a butterfly on the downside, but it's a little harder to do that the way that the volatility metrics move. The easier play for me right now is to try to play for the bounce, because I know what volatility will do in that case. I know VIX will drop if we rally back to like 280. We just look at the VIX here, and you can see that even with this last break, the VIX didn't make a higher high, and it seems like it wants to weaken, maybe all the way back down here towards 16.5, 17. If we get a firm rally here, we may see VIX back below 16 within a week or two. So that's something we just have to be watching for, is how low will VIX go if we get the bounce back. Okay. Let's go to tech. Tech is kind of weak today, frankly. A lot of this was driven by Amazon earnings last week. Just got hit hard. And we look at SMH, and, it bounced a little today, but it wasn't a mega run. We do have a higher high and a higher low, so maybe that's the start of something better. Something that we want to watch. I want to watch SMH. If I see SMH get back above the 10-day moving average, I think tech has some money flow coming its way. But, when we came out of February, the money flow went into IWM more so than into tech. You see that we had this big run March and April and May. Basically from April to May, when the trash was over, IWM kind of took leadership. It was the most negative during this break. It's now starting to reclaim some of the levels that it had tested from before. Again, above the 10-day moving average, we get excited. What's going to drive this guy? A lot of it's really financials, which are firm today, energies, which are weak today. Retail names like that are looking pretty good today. So if we start getting some signs that domestic United States is fine, IWM can go back to a leadership role and things start to look good. And we could see a situation where IWM severely outperforms the other markets on the way back up. Much like it led the market down, it could lead the market back up. But the first key is, you can see here on the 10-day moving average, it's been waiting the whole way down and using that as resistance. So you got to get above there for me to get really excited about IWM. And if I get excited about IWM, I get excited about everything else. So IWM is going to be my first trigger. SMH is going to be another one I'm looking at as a trigger to get us away from like a trading market looking for the bounce to actually saying maybe I can get some conviction on a rally, not a bounce. And a rally in IWM, I think, gets us back to 165, 166. So that's a long ways away. It's 10% up from here. So just kind of thinking about what I need to see in order to start getting there. And along the way, we'll see some, things like bull flags and bull pennants. And those are just trading opportunities until we get into a grinded out mode here. So, you see the little bull pennant here, grind it up, a little bull pennant or bull flag there, and then grind up, and then the chop. And once we get into the chop, but that should be months away if we do get a firmness here. Let me go to TLT. TLT implied vol is still staying high, but this isn't going anywhere, and it's basically seems like we got to this point where I don't know that TLT can go much lower. And the reason I say that is if it gets much lower, the market has clearly told us that if yields rise, it's not going to be happy. Well, that means that guys like Powell are going to recognize, wow, the 10% drop we've already had in the stock market was harsh. I'm not sure we can see 15% and have them continue on their rate hike pace. Okay? So even if the economy is showing good signs, if we see a 15% drawdown in the stock market that I think comes if CLT makes a new low, then they step back off of that idea. So if bond yields rise, and that's going to crush the stock market, then maybe, and then they would change their tune, then I got to think that we're just not going to see that downside. When everybody gets bearish on bonds, it's probably a good time to buy. You see some momentum indicators starting to show upside too. The MACD cross here happened during the consolidation. You can see this bit of a wedge forming, kind of a triangle shape here. It looks like we're getting into a point where maybe we break out to the upside. back up to 117 and change. But for the short term, I think the play is for us not to go down, and then in a few days, it might start getting into a play of looking for upside. Hopefully with volatility a little lower there, because implied volatility has risen in TLT and not yet come down aggressively. All right, so let me move over to GLD. Gold, my signal's really based on the dollar, and you can see it's getting some weakness today because DXY continues to be relatively firm. Dollar yen, which is has a little bit more of a risk on, risk off component to it as well, is bouncing back after getting hit. And by the way, this chart right here is not telling me that the market should be collapsing. If we were really worried about the market, I think that the dollar would have been weaker relative to the yen than it has been. So it's just something else to be keeping in mind. So I'm looking for downside in gold, and where I'm looking for is a move down towards 114 in the intermediate term, basically back into the range. Vol's pretty fair, maybe a little high in gold, so it's more of a put spread play. I talk about that more in the premium newsletter. It's already been posted for those of you that are interested. Silver is similar, and you can see that already got a big hit today, and it's already pressing back down towards the lows. So that's been the weaker of the two between gold and silver. I don't know that that's going to stop until silver gets down to the lows. If silver can get to the lows, I got to think gold is going to get an even bigger push potential as people start trading the pair. Let's finish it up with oil. So first I'll just look at USO for you. That seems to have stabilized here. It's not really going anywhere, not up or down. It looks, kind of like that same little, shorter term, but a little bit of a triangle sort of forming here, similar to what I saw in TLT. Using the 200-day moving average as support and the 100 as resistance. We've got the 10-day moving average coming down quickly. This may be about the end of that washout, and yet XLE got destroyed and continues to get hit. And OIH got destroyed and continues to get hit. And OIH made, made yearly lows here, while XLE was trading at the lows of the April move. I'm looking for this to bounce back, but look at the volatility levels in this guy. If I go to OIH, implied volatility has skyrocketed because there's fear out there. 38% versus 23%, that is a drastic difference in the pricing of the options. I can show you as an example what would happen if I put the vol back down. So let's say, month out options that are 36 vol here. If we go back to 24%, these options would be worth 20 cents. This is the value of understanding how expensive options are when they're expensive and how cheap they are when they're cheap. If volatility gets crushed, these go down by more than 50%, flat price, neutral. So for these to work, let's say we got a $1 rally and vol goes to 24%. These things are worth 52 cents. So November 30th, 22 calls could have a scenario where we rally $1 over the course of, say, a week. Vol comes off 12% over that week and a half, and I make no money. That's what I'm worried about with this sort of scenario, and that's why I look at different kind of structures in the newsletter. I'm looking for the bounce. I'm looking for it to bounce back here towards 23, maybe 23 and a half, maybe 24. But I don't want to have a big Vega exposure for that. And since I have a kind of price target here in mind, which is near this consolidation area, I can make a little bit more of an interesting structure with it. And I talk about that again in the newsletter. So speaking of the newsletter, you get the newsletter today. You get a video update on Wednesdays. It's $49 a month, and I'm giving you a week for free. So you can take a look at it this week, say, wow, I like what's going on here. I understand the value that's being added. I want to continue because at $49, I'm selling this dirt cheap because I want to help people understand how I look at the markets and start looking at ways to incorporate option strategies into their trading. All right, so sign up now, tradeacademy.co/Harwood Report. Take a look, see if you enjoy it. And again, it's risk-free for you because the first week is free. You can always email me, keith@tradeacademy.co, or call me 312-600-8004 if you have comments or questions. Thanks again, folks, and have a wonderful rest of your afternoon.